Hey guys, welcome back. So in this series we're talking about candlestick patterns, and in this specific video we're talking about the evening star pattern. This is what the textbooks call it. Let's look at it and see if it makes any sense and how we can use it in our own trading. So the theory behind this is it's a reversal pattern from the bear side after a bullish run. So we have a good move up, we then have a nice, good, strong, bullish candle here, assuming we've got an uptrend here. We have a second gap up here, and that can be either a bullish or bearish candle. The next day, this is the key point, is that we get a gap lower. So the gap is lower, and then we get a red candle here. So let me color those in. Hopefully you can see those. I haven't done those too small. So that's our bullish candle here. Then we have, this could be either, this could either be a red or a green. And my my kind of coloring here is standard stuff really. If you've got a chart package, the red indicates the close is lower than the open. If you've got a green, then the close is higher than the open. That can either be red or green. I don't think it matters. We'll have a look in a minute and see what the textbook says. So the point is that you get the gap up, and then it doesn't really continue. That's the kind of crux of this whole strategy, is that you've got a good, strong momentum move. Everybody's happy. It's driving along. Bulls are comfortable. Here we go, off to the races. You get a gap up again, a continuation. It just doesn't quite do much in the day. It just lets everybody down. But no problem, if you were looking at that from that perspective, if we just kind of block that out there, I think that's about right. That looks okay. It's the next day that's interesting because, and I'm looking at it here from a pure textbook perspective to see if they say what I think they're going to say. Exactly that. They're saying that the second day you get a bullish gap up, which is what we talked about there, and the bulls are in control, they can't push prices higher, and then day three you get the gap down. Exactly what we thought it is. So it makes sense. Often in the textbook sometimes you go, what, is that really how they're framing it? But it makes perfect sense to me. Let's discuss it a little bit more detail, guys. Okay, the gap up here, off we go. As we say, the gap day two or day three, so that's one, that's two, that's three. Day three, you get the gap lower. You would expect the bulls to step up to the plate and push it back up. This is where it gets interesting, because you get bears in control, driving it a lot lower. You get the solid red, and the theory is then that you're shorting it on the close of there. Your stop is above there, looking for a further continuation move. It's a reversal pattern, and the psychology of it is, yes, as we just said, buyers in control, buyers in control, buyers in control. They're still in control, still happy. The gap lower should be bought, isn't. Bears are stepping in. It's a potential reversal. Let's have a look at that from the actual 3 days on intraday perspective. So day one here is our good solid low to high trend day move. Classical, opens at the bottom, closes at the top. Pretty much 101 trend day. Day two, we've got a gap up, and we push up. So maybe we close at highs, or maybe we close in the middle, or maybe we close at lows. The point is, the key part of it is this little gap here. Yeah, that's the key perspective of it, is that you've got the gap up and a continuation, and a reasonably bullish close. Not necessarily monstrous, but okay. The key then, the actual crux of the whole trade, if you like, is in day three you get a gap lower, and then a trend day from high to low, pushing down. Bears fully in control of it. That's your trigger to say, hey, this is a reversal pattern. They've tried it, they haven't done it. We're getting an insight into who's in fully control here. There's more demand coming in the first part of the phase of the pattern. There's more supply coming in the second part. If we are, this is generally how you would use it. And in fact, let's look at that a little bit more detail. As it's a reversal pattern, we're looking to do it after some sort of uptrend, aren't we? So push up, we get this pattern at the highs, and we look to sell that for a move lower. That makes sense, and I kind of agree with that. One more thing I'd like to add to that, and if you've got any comments, then please stick them below. I'd love to hear what your thoughts on it. I quite like to see this if we're in a downtrend. Bear with me, we're a downtrend, we pull back up, we then get this pattern of the number one, the number two, and then that bearish candle there, i.e. 1 2 3 1 2 3, I would then look to sell that for a resumption of the downtrend. I quite like that in a scenario of where to see that. Maybe it's not a classical technical textbook strategy, but I like that because the wind's behind me already. It's a temporary move against the trend. It's that temporary pullback that you often get, and I'm waiting to short it anyway. That pattern, that evening star pattern, would be my trigger. I know that really probably, theoretically you want to see it up at highs, but if I look at that and say, well, that's like a week, 2 weeks, this is like another week here, it would be in a week. But I quite like it from the fact that, hey, bulls are in control. There's a little short-term uptrend, but no. We've got a resumption of the downtrend now. That's the trigger, the catalyst that I need to take it. And like I say, the textbooks would say to us, go short here with a stop above the high. That makes perfect sense, doesn't it? The theory is that if that is right and it's a genuine reversal, it's not going to go back up near that level. And that's the whole point of a stop, is that you want to come out when the premise of the trade is incorrect. And for me, that makes a lot of sense. If I was using it with this thing, I might have an uptrend here and then sell it on the break of the downtrend, but then really it probably isn't an evening star pattern. Yes, it may form an evening star after you've taken it, but you're front running it a bit, and you've kind of got to take the pros and cons that go along with that. So that's the evening star pattern, guys. Let me know what you think about that. It's actually quite a popular pattern. It's something that a lot of people use. Again, I think the most important thing is what happens previous and prior to this pattern. If it's in the middle of a range, in the middle of nowhere, it's kind of useless, isn't it? You have to have it at some sort of extreme. Maybe if you've got after a really big flush higher as well, that would be a nice place to have it. All those kind of things, I think, are relevant. So let me know what your thoughts are on this in the comments below. Do you use it? Do you think it's valuable? Have you got a little taste, a little flavor on it? Have I even done this right? Is there a slight difference to it that needs to be done to make it an official evening star pattern? Let me know in the comments below. If you like this video, give me a thumbs up. Thank you very much. And if you haven't subscribed, then please do so for more shooting stars, evening stars, candlestick patterns, technical analysis, discipline, psychology, strategy, setups, all that good stuff to help make us better traders. Good trading out there, guys. Take care. See you on the next one.